Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, How GASB Updates Could Impact Your Organization. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Keith Simovic and Kevin Mullerleile, both senior managers at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I'd like to turn the floor over to Keith to get the presentation started. Keith?
Perfect. Thanks, Amy. Well, welcome everyone. Hopefully you can hear me okay. Good morning or good afternoon, I guess, depending on what time zone you're joining us from today. We're really excited to have all of you here, at least in this virtual environment, for our annual GASB update presentation. And I hope many of you have gotten a chance to attend some of our other webcasts as part of our annual government webcast series thus far as well. For those of you who don't know me, again, my name is Keith Simovic, and joining me today as your co-host is Kevin Mullerleile. Both of us are senior managers with Moss Adams and enjoy spending the majority of our time working with governmental entities, just like all of you, which means that the topic today is very near and dear to our hearts, as we often get to spend a lot of time with our clients on things like interpreting and applying new GASB standards. So today, we're hoping to give everyone on the call a glimpse of the more significant standards that will be effective in the near future. And hopefully, if we're successful today, we'll be able to make this process of understanding how to apply the new standards just a little bit easier on everyone. And now just a quick caveat too, that our presentation isn't intended to cover all of the new standards that are currently out there. So you may see when you see the list here in a second that it doesn't include all the new standards, but even with just sticking to a few of the bigger ticket standards, you'll see listed on the agenda that we still have a lot to cover. So we'll go ahead and dive right in here. So you'll see on the agenda here, here's the list of the different standards that we'll be covering and kicking off with GASB 84 here in just a second. Real quick for our learning objectives. These consist primarily of gaining a better understanding of some of the newer standards that were listed on the agenda, and coming out of this better equipped to assess the impact of each of those and to help with developing or maybe you're just refining your organization's plan for implementation. And if we can accomplish those items today, then I think we've met our goals for this session. All right, so for the standards we're covering, we wanted to put together a quick visualization to help you get a better idea of when each of these will be effective. Now, one thing to keep in mind with these dates is that many of them are a bit delayed from their original effective dates, and that's because of GASB's issuance of GASB 95 last year, which, if you remember, that actually delayed many implementation dates as a result of the impacts of COVID-19. So you'll notice that the first one up is GASB 84, as I mentioned. That's one that, if you haven't implemented it yet, you'll want to have it on your radar, definitely, as it will be effective for this year. And a portion of GASB 97 will also be effective this year and will have an impact on the provisions of GASB 84. So we'll kick things off today by covering each of those two standards first before I turn things over to Kevin to discuss leases, public-private partnerships, and subscription-based IT arrangements. All right, so starting off with GASB 84, I have to say that this standard is near and dear to my heart as well, given that we've helped many of our clients navigate through the challenging aspects of this one over the past few years. Now, prior to the issuance of GASB 95, this one was initially slated to be effective for periods beginning after December 15th, 2018. So for many of our clients that maybe had 12/31 year ends, this was one that was needing to be implemented for the 12/31/2019 financial statements, up until the point that GASB 95 was issued and delayed the effective date by 1 year. So based on that, I would imagine that some of you may have implemented GASB 84 already, but may find that you'll need to make changes next year due to the impacts of GASB 97 that we'll talk about later. And we might also find that some may have started implementing a year ago, but then pushed out the implementation date another year because of GASB 95. Given all of the various moving pieces with GASB 95 and 97, as well as the complexities of the GASB 84 standard to begin with, I'm interested to see where all of you are currently at with implementation. So I'll pause there and pass it over to Amy for our first polling question.
All right, thank you. So our first polling question is, what is your organization's current status on implementing GASB 84? A, we've got this already adopted. B, we're adopting this year and have a solid plan that's underway for implementation. C, we're adopting this year, but we're not sure where to start with implementation. Or D, I've heard of GASB 84, but need more information on how it might impact us. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. Also, if you have questions during the webcast, please submit them using the Q&A window in your console. And if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. Okay, it looks like most of you have submitted a response. So here are the results.
Perfect. Well, thanks for that, Amy. And it looks like the responses are coming in kind of pretty much what I was thinking in terms of what we'd get back. I mean, just with the delays in this standard, kind of some of the complexities, the adding of GASB 97. I mean, everyone's kind of in a little bit of a different spot in terms of implementing this one. So kind of a spread between people that have already adopted, people that are kind of on their way to implementation, and others, of course, and hopefully that's why you're here today, is to get a little more information on this one as well, just to see what you might need to do or how might this impact you going forward. All right, so going forward, so I know the standard has been out for a few years now, and you may have seen other presentations on this topic. I know we've done other presentations on this topic as well. But before we dive in too deep on this one, we wanted to step back for a minute to understand kind of the why behind the standard. And prior to GASB 84, fiduciary activities and fiduciary funds were always a part of generally accepted accounting principles. But the problem was that the concept of a fiduciary activity was not clear in the guidance. So there were inconsistencies in what was considered a fiduciary activity by one organization to the next. And it was this wide diversity in practice that led to the need for clarified guidance to really kind of demonstrate what types of relationships would trigger the need for including fiduciary funds in a set of financial statements. That way, the standard setters hope to have more consistent application of accounting and reporting of fiduciary activities across all governmental entities. So within GASB 84, there are 4 categories of fiduciary funds. First, you have pension and employee benefit trust funds, and you can kind of keep in mind for those that could include defined contribution plans, not just defined benefit pension plans. Number 2, investment trust funds. 3, private purpose trust funds, which are basically fiduciary activities other than pension and investment trust funds and are held in a legally separate trust, meeting the criteria of GASB 84. And then 4, custodial funds, which replaces the current concept of agency funds that many of you may be familiar with. Now, fiduciary activities are required to be grouped in each of these categories and reported separately in the Statement of Fiduciary Net Position and the Statement of Changes in Fiduciary Net Position within a governmental entity's basic set of financial statements. So if you haven't had to report fiduciary funds in the past, but think you might need to under GASB 84 and some of the evaluation maybe that you've already done, just keep in mind that those 2 statements will need to be added to your financial statement reporting package in the year of adoption. So you'll want to work with your auditor, and if you have questions or need examples of what those might look like, that would be a good resource for you. Okay, so on this slide, we've listed just a few examples to get you thinking about what might fall under the category of a fiduciary activity, or at least what types of activities might need to at least be evaluated for whether they meet the requirements to be reported as a fiduciary fund. And in all of these examples, and as you start assessing the impact of this standard, the main theme to think about is, does my organization hold funds for the benefit of other individuals or organizations? Whether those be funds held in a legally separate trust or not. And what fiduciary relationship or responsibility does my organization have for those funds? I think those are probably the first few key questions to ask when trying to put together a list of potential fiduciary activities to evaluate. And now the list of examples that we've got on here, it's not a comprehensive list by any means. So going through these key questions with others in your organization, including all kinds of different folks, whether it be management level employees, finance and accounting, of course, HR. They'll have a lot of information about the benefit plans and retirement plans offered, and maybe even legal as well. And that would be helpful to kind of identify a complete population of potential activities to be evaluated. But this list here just gives you kind of a start to kind of think about, well, what might be considered potentially a fiduciary activity. So this next one, a component unit is defined by GASB as a legally separate organization where the primary government and its governance group, so you can think of a board of directors or maybe a city council, where that governance group is financially accountable. So both of those phrases in bold on this slide are key criteria in the component unit evaluation. But what do they really mean, and how do we apply them in our assessment? Well, so some of the questions you might want to ask to determine if an activity is legally separate would be, 1, does the potential component unit have its own name? Or 2, can it legally sue or be sued under its own name without any impact to the primary government? So for example, think about something like a defined benefit pension plan that has assets held in trust for the purpose of accumulating and paying pension benefits. If the plan and the trust were to be sued, could the assets of the sponsoring government also be at risk in that case? And if not, that could be one indicator that the plan and trust is legally separate from the sponsoring government in this case. Now for the financial accountability piece, there are a couple items you'll want to clarify, including whether the governing body of the primary government appoints a voting majority of the governance group of the potential component unit. So let's take the last example again. If the plan had a board of trustees, would the board of directors or city council members of the sponsoring government be responsible for appointing a voting majority of the board of trustees of the plan? And also, what type of financial relationship does the sponsoring government or the primary government have with the potential component unit? Now, again, in the previous example, if the government is responsible for making contributions to the trust, then there is a financial burden aspect that helps to build a case for the pension trust being considered a fiduciary component unit of the primary government. When that is the conclusion, then you'll see in a few slides that the flowcharts GASB has provided to help analyze potential activities are fairly quick and easy to complete in this case, as those component units will need to be included as fiduciary funds. So if you come to the conclusion that you don't have a component unit, keep in mind that you're not in the clear quite yet. And the next step is to determine whether the primary government controls the assets. So paragraph 12 of GASB 84 defines control as 1, holding the assets, or 2, having the ability to direct the use, exchange, or employment of the assets. So let's say, for an example, that the primary government holds the assets in one of its bank accounts and therefore has control. You would then move on to the next evaluation step, which is to determine the source of the revenues for the activity in question. Fiduciary funds cannot have revenues that are derived from the primary government's own source revenues. So then you might say, well, what does that mean? One good example of this is in the GASB implementation guide, and it's a scenario where a city charges a business license fee of $1,500 to organizations, but through a revenue sharing agreement, remits $150 of this to the state. The portion that the city holds that will be remitted to the state would not be considered a fiduciary fund, given that the assets are the result of the city's own source revenues in an exchange transaction with a customer. There are quite a few other good examples in the implementation guide, starting with question 4.35. So if you're going down this path on the flowchart, I would recommend kind of taking a look at those examples in the implementation guide for more insights on examples of own source revenue, so you can better kind of evaluate that piece. All right, so the last step is determining if the activity meets any one of the criteria listed here on this slide. Are the assets held in trust? Are they held for the benefit of individuals and not the primary government? And if not, are they held for the benefit of other organizations that aren't already part of the reporting entity? And if any one of those is met, along with the other criteria that we already went through, the activity would be considered to be a fiduciary fund. So for this slide, we wanted to provide you with a few guideposts to help you along with the implementation process. And I think the first and probably the hardest would be to identify the population of potential fiduciary activities. And I think this is an exercise that will require discussion and involvement from management and individuals outside of just finance to help identify the different, employee benefit plans, trust funds, agreements, or other programs in place where the organization could be considered to have fiduciary responsibility over the assets in question. And then once the population of potential activities is set, the next step is to understand some of the key facts about each potential fiduciary fund to help you navigate the GASB 84 criteria that we just went through. I think some great resources to help you navigate that evaluation are really kind of the actual flowcharts that you'll see included within Appendix C of GASB 84. We've included these on the next few slides, but I would suggest printing these out and referring back to them frequently when assessing any new potential fiduciary activities. And so we recommend reading through Implementation Guide 2019-2, that's one on fiduciary activities, again, because there's a lot of great examples in there to help you understand how to apply the standard. Now, I know there's a lot of info to soak in here, but I think it helps if we can start to look at how the standard is applied to some specific examples. So now I think we're going to move on to the next phase where we'll test you guys out and see how you're doing with some of these concepts. And again, real quick before we do that, we have included copies of the flow charts so you can get familiar with them. You can print them out. You can reference back to them later on. You're not planning to spend a lot of time on these during the session. But one thing I will mention, though, that I think isn't quite as clear in these flow charts as they could be is the very first decision point on chart 1 here. In the upper left corner of this flow chart, it asks about whether the assets are held by a legally separate entity that would be considered a component unit. I think that question, of course, is completely fine and appropriate, definitely. But I think it would be more helpful to start with an actual flow chart to help you make that determination of whether there is a component unit or not. So for that determination, you can kind of refer back to the slides we just went through to determine whether you have a fiduciary component unit relationship or not. You want to do that analysis well before you start thinking about some of the other criteria included in these flowcharts, including whether you have control of the assets or not. So just kind of keep that component unit piece in mind. So with that, I'm going to skip past these flowcharts, and again, they're just for your reference here and later on, so you can access the materials and print them out. But we'll move forward to our first example here. So for this example, let's say that you've got a cash or maybe other financial assets that the county sheriff sees from individuals suspected of committing various crimes. The assets are held by the county as they've been deposited into a separate bank account under the county's name. And we also see that the state law prohibits asset seizures like this from being property of the county until the time in which the court concludes that the assets were used in the commission of a crime. Now, if the court renders a conclusion that the seized assets were not used in the commission of a crime, then those assets remain the property of the defendant and are returned. So based on these facts, should the county report the seized assets as fiduciary activities until court judgment is rendered? With that, I'm going to pass it over to Amy again to administer the next poll and see what you guys think on this one.
All right, thank you. So the second polling question is, should the county report the seized assets as a fiduciary activities until court judgment is rendered? And you have a few options to select from. Remember, hit the button next to the answer you choose and hit submit. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And then also, if for those of you having difficulty seeing the slides advance or the polling questions pop up, please try hitting F5 and that will refresh your screen. Okay, we'll leave this up another 5 seconds. Okay, here are the results.
Perfect, thanks, Amy. And it looks like majority of you selected A, 54% of you selected A, which is the correct answer. And kind of the reason for that, 3 different things on here, right, when we think about the criteria. So it doesn't pass the test as a component unit, but remember, if we follow the flowcharts, there are a number of other criteria that, if met, could still trigger the activity to be reported as a fiduciary fund, even if it's not a component unit. So in this case, first, the county controls the assets as the assets are held in a county bank account. 2, the assets are not derived from the county's own source revenues. And 3, the assets are held for the benefit of the defendant until judgment is rendered. As all 3 of these boxes are checked, the assets are deemed to be fiduciary activities of the county. All right, so let's move on to the next example where we have a public utility district that bills and collects monthly customer sewer charges on behalf of the local city. And the local city owns and operates the sewer system in the area. The sewer fees collected are initially held in the utility district's bank account, and upon receipt from the customer, which then the district typically remits to the sewer collections to the city within 30 to 45 days of receiving the customer payments. And then at the district's fiscal year end, the district holds a material amount of sewer collections in its bank account that have not yet been remitted to the city. So based on all those facts, should the public utility district report the sewer fees held as a fiduciary activity of the district at year end? Now, we're not going to go to a polling question on this one, but I'll pause for just a second so you can kind of think about what your answer might be on this one, and then we'll go to the next slide. So just a second here. Okay, so the answer on this one is that it is not a fiduciary fund of the district. Now, although the district meets 3 criteria for reporting a fiduciary activity, including 1, it controls the assets, right? They've got them in their bank account. 2, the assets are not derived from the district's own source revenues, it's the city's. And 3, the assets are for the benefit of another organization, the city in this case, not the district. So it seems at first glance that this might meet that criteria, and we know that it's a material amount sitting there at year end. However, GASB 84 has a built-in exception in paragraph 19 that grants business type activities this exception for reporting fiduciary activities if the assets are typically held for 90 days or less. So in this case, we know that the assets are typically remitted within 30 to 45 days upon receipt. So the district meets the exception granted by paragraph 19. Now, I'll say, I know we tricked you a little bit with this one since we didn't really cover this exception in the previous materials, but we wanted to make sure that all of you on the call, and if you've got business type activities, were aware of this exception. So we've included that example here. Okay, so that's 84. Hopefully you're feeling a little bit better about that standard and that you've got kind of the tools, flow charts, and some other resources to help you navigate through the fiduciary fund evaluation. You know, we hope you feel that way at this point, but we do want to spend some time on GASB 97 as well, since just when you felt you had GASB 84 down, the standard setters issued GASB 97 just this last June, which ultimately changed some things about how GASB 84 is applied, specifically related to evaluating defined contribution plans. So think 401k plans, 401a plans, that type of thing. GASB 97 actually addresses a couple of topics, but the first part related to fiduciary fund evaluation is effective immediately upon issuance. And will need to be implemented in conjunction with GASB 84 if you're implementing this year. So we'll go over that piece first, and in a little more depth in the second piece related to IRS Code 457, deferred compensation plans. So during the year leading up to the initial effective date of GASB 84, the GASB had received a lot of feedback from organizations stating that the burden of including these defined contribution plans as fiduciary funds and also subjecting them to audit outweighed the benefit to users of the financial statements. And the main provisions under GASB 84 that will change with adoption of GASB 97 for defined contribution plans specifically is that the absence of a governing board does not mean that the sponsoring government is automatically financially accountable. That was previously the assumption under GASB 84 and caused many of the defined contribution plans out there to be included as fiduciary activities. And then in addition, the financial burden aspect that we talked about earlier was also causing some of these defined contribution plans to be pulled in as fiduciary activities if sponsoring governments were making any employer contribution to the plans. And so under GASB 97, this criteria won't or will now kind of not only be applicable to, or will only be applicable, excuse me, to defined benefit plans. So making employer contributions to a defined contribution plan, again, thinking of 401k, 401a type plan, that doesn't automatically create financial burden. So the intent of all this is that fewer defined contribution plans will be required to be reported as fiduciary funds. And if you've already implemented GASB 84 and ended up pulling in some defined contribution plans as fiduciary funds, I would say, or recommend spending some time reading through GASB 97 and reassessing whether those plans would still need to be included as fiduciary funds in the next reporting cycle or not. Now, there's still a chance that some defined contribution plans would still need to be included if the other fiduciary criteria, kind of other than the component unit criteria, if those are met. So just keep in mind that this new standard doesn't automatically scope out all defined contribution plans, but it does limit the applicability of certain criteria, making it more difficult for those types of plans to be considered fiduciary funds. Okay, so we'll move into our last example here that will help test our knowledge over not only GASB 84 in this case, but the provisions of GASB 97 as well. So in this scenario, we have a local government that sponsors a defined contribution plan, but the plan itself does not have a governing board. The sponsoring government has typically made employer contributions to the plan each year, and we know that the assets are held for the benefit of the individual participants and their beneficiaries. So based on those facts, is the defined contribution plan a fiduciary activity of the sponsoring government? Let's go ahead and get the next poll started. So I'll pass it over to Amy and we'll see what all of you think.
All right, thank you. So the third polling question, is the DC plan in the previous example a fiduciary activity of the sponsoring government? And you have a yes, it qualifies, no, B, no, it doesn't qualify, or C, it depends. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And we will also be sending the slides via email tomorrow, along with a recording of the webcast. Okay, it looks like most have responded. So here are the results.
Perfect. Thanks, Amy. Yep, answer C, that was the majority, 62%. A lot of you know that whenever an accountant puts out a question out there with a possible answer that says it depends, it's usually that one. So good response there. And the reason for that answer is that, yeah, the defined contribution plan is not a fiduciary component unit of the sponsoring government, but we probably need a little more information and evaluation to be done to determine whether the assets under the plan meet the other criteria under GASB 84, including whether the local government has control of the assets. In many cases, I'd say you typically find that the assets for a defined contribution plan are held in a trust and the government does not hold those assets or have the ability to direct the use of those assets. And in that case, the plan would likely not meet the criteria of a fiduciary fund. But we just bring this up just to keep in mind that this additional evaluation is always necessary, even if the plan doesn't meet the requirement to be considered a fiduciary component unit, as there's still a possibility it could meet the criteria of a fiduciary fund based on the other steps in kind of the new standard and those flow charts that we went over. Okay, already went past those slides. All right. So then the next portion of GASB 97 touches on a different subject that relates to the accounting and reporting for IRS Code Section 457 deferred compensation plans. This portion of the standard isn't effective until periods beginning after June 15th, 2021, and it supersedes the previous guidance related to 457 plans under GASB 32. Now, the intent of this section of GASB 97 is to provide more clarity on how to account for and report 457 plans, depending on how they're structured and whether they meet certain criteria. So under GASB 97, Section 457 plans that meet the definition of a pension plan, and this references over to the definition as listed in GASB's 67 and 73. They meet that definition, they're to be treated like pension plans in terms of the accounting and reporting requirements. Once that determination is made, you'll want to go back to the start of this presentation and apply the provisions of GASB 84 to, again, evaluate whether that 457 plan should be reported as a fiduciary activity or not. So if you have any 457 plans at your organization, you may want to jot down the definition listed here that we've pulled straight out of GASB 67 and 73, and this will help you determine whether the plans meet the test to be deemed a pension plan or not. Now, the good news is if the plan does not meet this definition, the provisions under GASB 67 and 73 would not apply, and the 457 plans would be considered what's, quote, other employee benefit plan for reporting purposes. And you would likely not have to report much in your financial statements related to the plans. But again, keep in mind that you would still have to evaluate the plan in connection with GASB 84 to determine if any fiduciary reporting is required. Okay, well, with that, I know it was a quick crash course on 84 and 97, but right now I'm going to turn it over to Kevin, and he's going to walk you through the next standard, which is the new GASB 87 leasing standard. So thanks again for your time and attention today, and we'll be sure to take a look at your questions and get back to you all after the presentation.
Very good, Keith. Thanks for turning it over to me. I'll take everyone through the back half and take us to the top of the hour going over statements 87, 94, and 96, and we'll get started here with leases. Statement 87 came out 4 years ago in June 2017. I suspect many of us didn't jump on that one right away, but now we're getting awfully close to go time. Today, I'm mainly going to touch on the practical application of the statement, just not time today to go into all the implementation of it. If you want to go through a deep dive, we have put out several webcasts, and I know that there's one from July 2020 that Keith and Olga Darlington presented that's available on our website. I believe there's a link again at the end of our materials there. Shown also on this slide are some important implementation guides that I think everyone should take a look at. 2019-3 came out in August 2019. That has 77 Q&As. Implementation Guide 2020 came out in April 2020. That added 12 Q&As. And then not included here is the most recent one in May. We saw Implementation Guide 2021-1 come out, adding 19 Q&As to take us up to 108 Q&As for leases. So that tells us right off the bat this is a meaty standard that definitely requires some attention. Of course, Statement 95 came out, and last year I think many of us grabbed that and took advantage of that, delaying implementation 1 year if you're a June 30 year end, 18 months if you're a December 31 year end. That'll get us to a polling question touching on how you may be implementing that on terms of timing.
All right, thank you. So our fourth polling question, when does your organization plan to implement GASB 87? A, during the original effective date in the standard for reporting periods beginning after December 15th, 2019. B, not until after the postponement under GASB 95 for reporting reports beginning after June 15th, 2021. Or C, already implemented. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And if you have difficulty doing that, we will be sending them out via email in a couple weeks as well.
Thanks, Amy. I believe this question was asked last year, and I saw that 2/3 of respondents said they were going to wait until the last minute to implement the standard. So see if it's similar to that.
All right, let's see the results.
Not until after the postponement. So yeah, about 70%. That's in line with what I was thinking. So like a number of GASB standards, whether it's evaluating a component unit or a fiduciary activity like Keith just walked through, control is really king. It's really important. That's no different with leases. My next slide is going to discuss control. Other key matters that are in the definition of a lease that you need to understand are legal enforceability, length of the contract term, and the fact this needs to be either an exchange or exchange-like transaction. Here's kind of a depiction of control. You know, on the one hand, you have full control. The other hand, you have no control. This kind of points at, we really have gray area. It's not always black and white. So who actually controls the asset? This comes up often when I'm dealing with governments on capital assets. One government purchases the asset, the other government maintains the asset. Control is really in question. In practice, there can be more gray areas surrounding control than we probably like to think about. And I'm bringing this up to emphasize the importance of using good judgment on deciding control and documenting your methodology on how those decisions are reached. It just makes the decision making easier going forward and helps when questions are asked later on. What we have here are the scope outs, which are always important to look at when you dig into a standard. I want to make it clear these items aren't necessarily out of sight and out of mind just because they're scoped out of leases. There's other GASB standards, of course, that will dictate how these matters are reported. A few of note, intangibles include various natural resources, including software. Software can be tied to all things IT. IT software is scoped out from leases and as it pertains to software licenses, but software license subscriptions are subsequently included in GASB 96, and I'll touch on that later. Also, don't confuse IT hardware lease arrangements with software. Leased IT hardware remains very much subject to GASB 87 and lease reporting. With service concession arrangements here in the middle, that goes all the way back to GASB 60 guidance that came out probably about a decade ago. Subsequently, though, GASB issued Statement 94 on public-private and public partnerships and availability arrangements, and that gets into service concession arrangements more. So you really need to look, are we scoping it out, or does it fall into GASB 94? And then finally, I'm going to touch on the supply contracts at the bottom. That's an exception for power purchase supply agreements. And it's important to read the terms of those contracts to make sure the underlying requirements don't give you the right to use the underlying assets, like in the case of a generating facility. If you do convey control of the right to use the generating facility, that will fall under GASB 87. So where to start looking for leases? In evaluating this monster of a standard, the biggest risk I see is making sure you're not missing large material leases. And while one individual lease may not be material, several of them combined may be material to your financial statements. Any kind of exercise you can do where you think about, one, what assets you're using owned by someone else, or two, what assets you're letting someone else use that you're actually owning, is going to ensure, I'm hopeful, that you don't have any gaping holes in capturing all leases. And I really want you to focus on big ticket items. You always hear about those stories where a capital asset is being built right across the street from the controller's office. They can see it out the window, but somehow that capital asset wasn't included in the current year additions. So just some funny stories like that you don't want to miss. And then in the middle here, certainly be sure to evaluate all leases you disclosed in prior year financial statements. That's kind of an easy one to make sure you hit on, I think. And then also take a pass through some GL accounts like miscellaneous income, where maybe you're capturing rent income, or conversely, your rent lease expense accounts. Of course, if you're in the business of renting, it's likely not buried in a miscellaneous type of account. Hopefully you already have good systems in place to account for those transactions. So once you figure out all the leases, what do you do with that data? Well, I really encourage everyone to capture that data in a word searchable PDF. I've been practicing for a number of years now. I remember when PDFs were not word searchable, I'd see a 150-page document. Hopefully your leases aren't that large, but I'd have to walk up from my desk, take a breather before diving into something that large. So it's really important to have word searchable documents. And I really think if we're not there yet, we're probably going to get to the day where we have AI software that can read these agreements and really help us. So while we may not be there yet with that AI software, I think if we have word searchable documents in place right now, when the software is available, we can jump on that technology. Ultimately, I think the lion's share of you are probably going to summarize lease data in spreadsheets. And as with any work paper, make sure you have appropriate access to the information. You can understand what changes are being made as the data is being updated real time. Here's a list of information that's really critical in calculating lease provisions. If we had more time, I'd go into all the requirements, but these are the critical matters you're going to want to have in your calculations. As far as making the lease journal entries, this is your first time that you're going to be doing these calculations. So I really say it's best in year one to have a lot of eyes on your accounting, on the entries that you make. I'm thinking back to Statement 68. implementation for employer pension reporting. And it wasn't unusual to see spreadsheet errors and templates or journal entries that were entered backward. I think the more eyes you have on this in year one is really going to help out. So reach out to your peers, have them troubleshoot templates that you're working on, and ask your auditors for technical guidance up front. If you do have software that can assist, that's also a big help. I'm hearing about clients that have debt software packages or capital asset modules that they hope to use to account for leases, but I generally think most of us are going to be using Excel spreadsheets. And if you do have covenants that can be influenced by lease accounting, mock up how those lease changes are going to impact your financial statements. And if you are concerned, have conversations up front with your lenders or other regulators that dictate what those agreements look like. See if you can make adjustments up front. Here's a list of policies and procedures to think about. These are just types of things that, if considered and implemented in advance, hopefully can help reduce hardships when you're in the final crunch of drafting the financial statements for audit. And then my final slide on leases, it's common with any accounting standard. We have that box at the end that says you can leave out immaterial matters, but let's realize that there is some judgment to materiality. A lease may look immaterial in terms of dollars, but if it impacts something like a covenant, it could be considered qualitatively material. The audit community suggests that preparers take advantage of materiality considerations whenever possible, but really do document that thought process. If you're going to set up thresholds such as we aren't going to capitalize off this equipment that's less than X dollars, make sure that those policies and procedures are thought through and documented. Okay, so GASB Statement 94, this was issued in March of 2020. And I know some people don't like alphabet soup. I'm not going to say public-private and public partnerships and availability arrangements throughout the slides. So if I use PPP, please forgive me on that for efficiency purposes. A purpose of Statement 94 is to fill a hole that was left when Statement 60 came out on service concession arrangements. People would look at Statement 60, see that a government doesn't control the rates being charged, and then they would just move on and not account for it as an SCA. And this statement, in part, is issued to fill that gap. The terminology on PPPs is similar to leases. The transfer is the one owning the asset, and the operator is the one that is given the right to use and operate that asset. Right to use the asset is an intangible asset. There's often a liability side to these PPP transactions. The definition of a PPP is essentially a government contracting with an operator, and that operator can be a government or a commercial entity, to provide service to the public by conveying the control of the right to use or operate infrastructure or an other non-financial asset. PPP can fall under Statement 87 leases, but it can also fall under the statement I'm talking about right now, 94, and that's confusing to people because I think PPP, it's right in the name of Statement 94, but it may actually fall under Statement 87. PPPs that fall under Statement 94 need to either meet the definition of a service concession arrangement or require the operator to improve the government's asset or add an asset that will be provided to the government at the end of the arrangement. Think back to Statement 87, which we just talked about. We said that SCAs are scoped out of the lease financial reporting standards. As we were told back in Statement 60 on service concession arrangements, or where the operator collects and is compensated fees from third parties and the government has the ability to modify or determine the services the operator is required to provide, including the prices or rates that can be charged. And then finally, the government is entitled to significant residual interest in the service utility provided by the PPP asset. So there's really a number of components to service concession arrangements, and if any one of those is tripped up, you're kicked out of an SCA reporting. And then in turn, we're probably looking at lease financial reporting. Here's the transfer reporting, and I'll let you read that. I haven't, in practice, had many discussions with clients yet about Statement 94. I think I come up with discussions most often in higher ed, where universities are having an operator construct or run something like student housing or a cafeteria. But I'm sure all types of governments will see something that's possible. We got about 10 minutes left. I'm not going to get into the definition of availability payment arrangements. That's here. I want to leave some time for software. The basic provisions of the availability payment arrangements relate to the design, finance, or construction of infrastructure or other non-financial assets where ownership transfers by the contract's end. Government reports this as a financed purchase of the asset. Now, if instead the arrangement relates to operations, it's expensed in the period the payments relate rather than being treated as a financed asset purchase. But really, that's what I wanted to hit on in our short time with Statement 94. It's going to be first implemented for June 30 year ends, and that'll be June 30, 2023, and then subsequent period endings will be after that. If implementation is applied to an earlier fiscal year, the PPPs should be recognized and measured using the facts and circumstances that existed at the earliest fiscal year restated. And I think that takes us to our final polling question. Or maybe not. I'll move on. So, subscription-based IT arrangements. I'm going to also shorten this and call it SPIDA. Hopefully you're fine with that. In recent years, I think it's more common to have cloud-based IT subscriptions, and that's really the purpose of this standard. I think probably many of us in our own personal life, we maybe used to buy music CDs, and now we probably have subscriptions where we access music, and we don't go out and actually buy the CDs. That's very similar to this accounting standards as it relates to governments. So similar to Statement 87 and leases, SPIDA transactions require the lessee to recognize an asset and a related liability, except for short-term arrangements. In the box here on the bottom of the slide, we see that this standard is similar to Statement 51 on internally developed software, where we have 3 phases of costs. Remember, in terms of capitalizing costs, it kind of goes in a chronological order: red light, green light, and then back to red light. We have a red light for the preliminary project stage payments. We expense those costs. And then when we're in the initial implementation stage, there's a green light, so go ahead and capitalize those costs. And then once the software is up and running, back to red light, we expense those costs. An exception can be some additional implementation stage costs addressed in an upcoming slide. I'll talk about that. Here's the definition of SPIDA. SPIDA is a contract that conveys the control of the right to use another party's IT software alone or in combination with tangible capital assets as specified in the contract for a period of time, again in an exchange or an exchange-like transaction. Realize that an exclusion to SPIDA is if the software is an insignificant portion of the underlying asset. That's really common these days with office equipment, vehicles, even machinery. All these types of assets are loaded with software these days. However, the software is generally a small component of the asset. Nice to have, but it's probably not the main purpose. We have the asset. As a result, the financial reporting is probably going to follow lease accounting under Statement 87 rather than Statement 96. And And then here's just another depiction of the 3 stages of the software arrangements that we've subscribed to. Something to keep in mind is when you talk to salespeople about getting into these types of arrangements, you know, they're pretty good about letting you know that once you're up in the cloud, you know, you're good to go. You don't need to worry about any other costs. But, you know, things come up once the software is operating, and it's important to have systems in place at your government to make sure you're capturing these additional costs because they can be capitalized. An example is if you later need an additional module and you need to get that implemented to fully realize your capabilities, well, those additional implementation costs can in fact be capitalized. So having systems in place to make sure that you're not just expensing those, you know, especially if you're business type activity, you want to capitalize costs generally. Important to have that in place. And then what's the effective date for SPIDA? Well, just like 94, Statement 96 on subscription-based IT arrangements is to be implemented in fiscal year end. First, June 30, 2023. And if you're September 30, December 31, you're also in 2023. And then, you know, the facts and circumstances are permitted but are not required to include capitalizable outlays associated with the initial implementation stage and the operation additional implementation stage incurred prior to the statement being implemented. So I haven't had a lot of discussions with my clients on SPIDA yet. I think everyone's really looking at leases and, of course, more importantly, fiduciary activities that Keith did a good job talking about. But we're not that far away from SPIDA. We're not that far away from taking another look at service concession arrangements under the new Statement 94 guidance. So that's what I wanted to talk about in terms of Statements 87, 94, 96. Looks like we have had some questions that came up, and we don't really have time to address that, but Keith, myself, will follow up and reach out to you, and certainly appreciate everyone's time and attention today. The final slide here has some of those Moss Adams insights and resources you can click on that have past webcasts that you can easily access on demand and listen through those. So I encourage you to do so. And with that, I'll turn it back to Amy. Thanks, everyone.
All right, thank you. And thank you, Keith and Kevin, for a great presentation today. And thank you to our audience for your participation and for submitting your questions. Feel free to reach out to our presenters if you have any additional questions that come up. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And if you participated as an individual and met all requirements, your certificate is available to download now in the CPE progress window. I will keep the console open for a few minutes to give you time to download. A copy will be emailed should you have any difficulty downloading it now. And here is a link to an online survey for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.